I tend to be on the Friedberg Druckenmiller side of this thing. Druckenmiller had a great quote in this interview he just gave. I don't know, Friedberg, did you mention this last week? That he said that he compared the debt ceiling and fiscal spending to worrying about whether a 30-foot wave will damage the pier when you know there's a 200-foot tsunami just 10 miles out.
Yeah, I saw that quote.
So what he's saying is, like, our short-term situation is bad. The long-term situation, which isn't even that long-term, like 10 years out, is even worse. And I think there's a growing feeling that our political system is just not up to the challenge of dealing with these problems. It just seems fundamentally unserious. We never discuss it. The media doesn't really present us with accurate information, and it has an agenda.
Do you guys want to make a bet? Sachs, you want to make a friendly wager with me?
Sure. What's that?
Okay, I will bet you that debt to GDP gets to 200 before it gets to 50. And I'll bet you however amount of money you want, and we can do it for our own personal gain or for charity.
That may well be true, but the question is how bad is 200% debt to GDP? I don't think that's a really bad scenario.
I mean, I really don't think it matters. I think the point is,
if we think it's coming, left if that happens,
yeah, we'll have a lot of money. You'll just have to profit from it. If you think it's happening, your job is to profit from it. I'll make the same bet with you, Friedberg. I think it gets to 200 before it gets to 50. Or 250 or 300, you can pick your number.
I think it will too. I'm just like...
Let's do the math on that real quick. So the size of GDP is what, about 25 trillion, and we're at about 32 trillion in debt. If we're to have 200% debt to GDP right now, we'd be at 50 trillion of debt. Now, let's impute an interest rate at which you would need to finance that.
4%.
So I think 4%.
You have to calculate the duration.
I understand, but just
it's always going to be 4%.
Let's like baseline. Yeah. Let's just baseline. So let's say 4%. So 4% on 50 trillion is 2 trillion a year.
Yep.
Which isn't that like half the budget?
Yeah, more. And that's my point. That's why you have to see taxes go up to over 70%, because it's the only way you got to tax everything in order to fund that. So
the U.S. government has collected 2 trillion in fiscal year 2023. Now, I guess we haven't done a complete year, but let's do 2022. It basically collected 3.7 trillion.
Right. You're using more than half of the government's income based on the current tax rates to fund the interest payments on your debt. That's not even to pay for social services. That's not even to pay for the defense. That's not even to pay for government services. That's just more than half of the income.
I guess maybe we're just speaking past each other. I guess you guys are expressing anxiety and concern, and I'm just expressing, here's how one would make money, because it's pretty obvious what's going to happen. We're going to 200. We're not going to 50. So I just kind of
How do you make money?
I think there's a lot of ways that you could make money. I'm not going to share those on the pod anymore, but there's lots of ways you can make money.
What's the trade there?
Stan Druckenmiller said...
It's the opposite of Stan's trades, actually. So,
oh, okay. That's good.
That would be an easy way to actually... If
so
you think
would you go long the dollar and short gold?
No, because those are like antiquated ways of making money where you have to have these convoluted derivatives agreements with these banks. And I've done these before where you're levered up to billions of dollars of risk. It proves nothing, and I don't sleep well at night. I think that there are simpler strategies that you can implement, but I think Stan is basically betting that the U.S. will break and that we will be forced in some way to bring debt to GDP closer to 50 than to 150 or 200. And I would just bet the opposite. And it's not because I want it to happen or that he's not intellectually or morally right.
Also, inflation down again. We've kind of gotten used to this, but I thought this was a particularly interesting chart. If you look at food, goods, and energy, all going in the right direction. Services still very expensive. Any thoughts on the Fed and inflation as we wrap up on sort of where we're at here? Is it another 25 basis points?
Core inflation is very sticky.
Yeah.
Right. Yeah. I mean, with CPI is down to 4.9%, but core actually...
Core was up.
It was up. It was up, what, 5.3%, something like that?
Yeah, core was up.
So, yeah, the Fed it raised another 25 basis points. What were we up to? Like 5.25%. I was ready to stop, 2 hikes ago because I thought that the economy was breaking and the banking system was breaking. They're up to now to 5.25%. You've got core CPI still sticky. Yes, CPI is coming down, but it looks like, inflation's still a problem. This is not a great setup for economic recovery. And if you believe, here's the problem with accepting the idea that inflation is just going to be persistently high, is if inflation remains persistently high, then the Fed won't be able to lower interest rates. So they'll need to keep them elevated. They might even need to keep raising them. And if that happens, there'll continue to be incredible stress on the banking system, and more banks are going to break. And then eventually that will create the conditions for a financial crisis.
I think the thing you guys have to be open to is the fact that we've never really tested the ability for the US to borrow durationally beyond 30 years. And again, we talked about what an error it was in judgment for the Treasury not to issue 100-year bonds. But I think if there's any country in the world that can issue 100-year bonds, it's the United States of America. And I do think that they'll be able to get durational assets that are that far out on the yield curve. So I, again, am less concerned about the debt wall here because I think you'll be able to push maturities out. You'll be able to refi a bunch of short-term obligations into the future. And if you look at where the yield curve is, 10 years at 3.5, 340 something. So the thought is that inflation goes down. If you put it out to 100 years, I would be very surprised if 100-year rates, if they priced a bond, weren't somewhere sub 1%. So I do think it becomes effectively free money for the United States. And I think it's just a practical thing they need to explore. By the way, corporates have explored these 50-year bonds and greater. So I think it's just like it's a matter of mathematics, as you guys have just illustrated here, that the U.S. has to push out past 30 years. So we'll have 50-year U.S. bonds. We'll have 100-year U.S. bonds. Again, I'm not here to claim whether it's right or wrong, but I think the simple way to acknowledge that is just that we are going to reinflate the money supply over the long term because it's the only sustainable way that politicians can get elected and reelected. And I think the best thing to do there is to own risk assets.